This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Markets are partying like it's 1999, and the road to revenue growth for those at the party looks like it's a clear path ahead. So today we'll look at what's paving that road and reflect on similar trips in the past, which encountered some chicanes along the way. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and I'm not going to spend a lot of time this week dwelling on economic indicators for a change, as they are not the story in the markets these past couple of weeks, but I'll give a little bit of lip service to what broke out this week before I move on. On Thursday, we got actually a bevy of economic data, important indicators that were not the story that moved things, but we got the PCE inflation reading, which was a 4.1% number on an annual basis, which was actually right at the consensus estimate, 3.4% at the core reading without the oil and food costs. That was a wee bit above the estimate, and 0.32% for the month-over-month core reading, a bit below the estimate, albeit higher than the previous month, well above the Fed's stated goals of where they'd like to see inflation, but it didn't matter much as rates actually were trading largely lower for the day. We also got the final reading on the first quarter GDP data, which showed that the economy factually grew at 2.7% for the period, 2.1% for the quarter-over-quarter reading, but a somewhat shocking reading of what's known as the GDP consumption data. That was zero. Basically zero for the period. And that's a reading of what the consumer's spending was, that consumer spending is basically stalled out in the first quarter. Still, no matter, as the market's focus was completely elsewhere, the real news of the day was the big earnings Wednesday night for Micron Technology. And this is where I add my disclaimer, but I'll say this time that I don't own any shares of Micron. And we as a team don't maintain a large position in it for our managed portfolios, although for unique reasons, there are some clients who do own shares of it here and there. I'm basically neutral on the name, more interested in what it means for AI expansion, but I'm also, as an investor, more interested in other areas of this AI revolution. As of this recording, NASDAQ is actually down for the day, but Micron brought some optimism back into the space, which had seen some erosion over the past week. The NASDAQ down a little bit more than 5% week over week. What we're seeing in some of the trading is that money is not flowing necessarily net into the stocks, but perhaps rotating. That, in this case, Micron might have been taking some money out of other areas and some other big names that I'm not going to get into, so I don't have to disclaim them. They're just basically trading capital between stocks recently. But for the previous week, and even before that, Micron was part of the sell-off. It's trading even now about 17% lower than its recent all-time highs. And the narrative before Thursday trading was that memory chips, the DRAM chips, which is what Micron specializes in, are still basically a commodity. Unlike some other chip companies, which have maybe a more competitive advantage because of their advanced chip designs or an ability to make custom chips for their customers. But despite these memory chips not being distinctive, they continue to enjoy this massive demand cycle with supplies that aren't coming close to meeting the orders that are out there. And Micron chips may be commoditized, but what they've demonstrated in this quarter is that they're locking in long-term contracts many years out with massive advanced payments on chips they don't expect to deliver for years, such that the hyperscalers are promising them orders and they're going to pay for the chips, contractually pay for these chips, even if 3 years from now they decide they actually don't even need all those chips, but they're contractually bound to buy the chips and they're giving them an advance payment of a huge chunk of that contract already. There is such a lack of supply that the hyperscalers are agreeing to these terms, which gives Micron tremendous visibility into future revenues. And in previous cycles, these memory chip makers ramped up capacity, chasing after all this increased demand as it swelled up. And they were ultimately left holding the bag when demand waned, and all the profits for the chip makers were more or less wasted. They were rolled into their new equipment to try to meet that capacity. Not a chip maker, but a great example of this was Foxconn. They were notorious for this, as they kept racing to build up more and more manufacturing capacity as the demand for the iPhones, which they were manufacturing for Apple, kept going up and up and up. And Foxconn did not bank a lot of their actual free cash flow. They overinvested in manufacturing capacity. They spent the bulk of their free cash flow, and they failed to participate in the rewards of the cycles. And in this turn, the chip makers like Micron are now reluctant to build supply in the same fashion. They're preferring instead to take pricing and drive huge profits, while Micron and Samsung and some of the others that build these basically interchangeable memory chips, they're just slowly adding capacity, but at this like kind of reluctant pace. And instead of using the bulk of their free cash flow they're to build more facilities to try to meet demand and capture share, they're instead capturing prices and rewarding shareholders and banking the profits. So they're locking in revenues for years to come at prices that are inflated over anything memory chips have ever seen in the past. And they're taking a big portion of those revenues in advance payments, as they're able to ask for almost anything from these hyperscalers who are absolutely desperate to get their hands on the chips, who are also desperate to get their hands on the energy needed to power what they're doing, and who are desperate to stay ahead of their competition. Now, per Micron's CEO on the conference call, they expect supply to start to improve in 2028, so still a while to go. But even then, he says they don't have visibility as to when supply will come to start to even meet the foreseeable demand. They're reinforcing the theme we've talked about many times on the show, whereby it remains unclear who the winners ultimately may be in the implementation of AI. But it's those that are selling the shovels in this gold rush that are getting very, very rich. Of course, that's coming at a huge cost to those that are buying the shovels, and they're covering a big part of that cost by taking on enormous amounts of debt. So I'm going to take a quick break here, but when I return, I'm going to look back at history, at other cycles, at other booms and busts, and take a look at the policies that led to where we are today, as I reflect a bit on, we'll say, the professional life of Alan Greenspan. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Every asset class, equities, metals, oil, and treasuries seem to trade more and more like crazy meme stocks. Discipline and patience are lost arts. How do you keep focused when others don't? Tune in every week as we discuss the latest financial trends and what investors need to know. To keep your eye on the ball and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. This past Monday, Alan Greenspan passed away at the age of 100. And of course, will always be remembered for leading the U.S. economy as the Fed chair and the markets through a period of almost 20 years of general expansion, with some big notable bumps along the way, and maybe with some of the policies ultimately that may have contributed to the great financial crisis that occurred just a few years after he left office. So I think it's worth reflecting back on his time to learn about the good, the bad, and think about what that means for us today and what it may mean for what we're seeing going forward. First, let me step a bit further back. Actually, let me first lay out that today, Fed funds rate today, just to give us a reference point, it's politically being debated whether or not we should cut rates, raise rates. Maybe the Fed is following policy, maybe they're following the data. But today, the Fed funds rate is 3.5%. Before Greenspan took over at the Fed, Paul Volcker took over. Paul Volcker came into the Fed in 1979, initially where the Fed funds rate was 10%. And Volcker is best known for attacking inflation, which had gotten widely out of control in the 70s. But it was already 10%. But under his term, it actually was lower by the time he left, at 6.5% by 1987. But even though rates were already pretty high in 79, inflation at that time was still rising and running also. Inflation in the country was at about 10% when he took over. And he would lead a Fed that would aggressively attack by raising rates as high as 20% before they were done hiking rates. And in the U.S., productivity at the time was collapsing. Industry was fleeing the country. We were dealing with the inflated costs at the time of their peak of the Cold War, as well as, of course, the effects of an oil embargo. And we hadn't yet realized this next generation of economic exceptionalism that would spring from our leadership in technology and the development of technology that would soon follow, and which would go on and last through today. But Volcker did pass along to Greenspan the evolution of those outside forces aside was ultimately a U.S. economy in which inflation was tamed, running in the low single digits by the late 80s, with an economy that was growing steadily above 3%. Deregulation leading to even more efficiency in the economy, but also maybe allowing for some abuses that we'll talk about in a minute. But a time when the biggest economic challenges of a generation were seemingly behind us, and the path to prosperity, that road of where the markets were going, was seemingly very clear, except for a little bit of a 20% market crash that came about 2 months after Greenspan took office. Other than maybe then contributing to the dot-com bust, we also got the groundwork that would lead to the biggest economic challenges since the Depression that came soon after Greenspan retired. But that crash in 1987, that moment really changed monetary policy in the landscape forever, up until at least now. The Dow fell about 20% that day in October of 87. It actually squeaked out a gain for the year, but it actually took about 2 years to once again reach the levels that it previously peaked at before the crash. What changed that day, though, was that Greenspan, new in his role to Fed, stepped up and created what would then become known as this Greenspan put. With him now retired and then gone, it's become known as the Fed put. But we had the Greenspan put by the Fed at the time of the crash, pumping in a ton of liquidity into the banking system and letting it be known that the Fed wasn't going to allow the banks to fail, and it was encouraging them to lend heavily into the aftermath to lead to a recovery after the crash. And this brought stability to the markets after the crash, which initially the crash itself was sparked by really lofty valuations and also ultimately sparked by some esoteric technical trading strategies that kind of led to a looping cycle of selling. But the backstop that the Fed provided set the stage for what would then be repeated again in a much larger scale in 2008 and 2009 and the years that followed that great financial crisis. The crash was followed in 87 by the prosperity of the 90s, where unemployment fell, U.S. saw continuous productivity gains, and the Fed remained nevertheless content to leave rates low. Inflation was largely beaten, unemployment was go. They didn't see the need to raise rates, though, which allowed valuations to go even higher and a lot of leverage to build up in the economy, at which point the Fed had to step in again to provide support during two shorter-lived crises of 1997 and 1998, which I have some weird memories of. But that, of course, was alongside an otherwise huge run of innovation, first just in computer technology, but ultimately in the development of the internet and the stocks associated with it, which saw the NASDAQ rally over 1,000% in the 1990s. And this might start sounding familiar to what we're seeing in the markets today. In fact, while I am definitely not here to say that this is any type of similar bubble to 1999, I will reference an interview I saw this week with Seth Klarman, who is Baupost Capital. He's a notoriously risk-adverse investor, not a perma-bear, but very risk-adverse. And he doesn't give a lot of interviews, but he said in this interview this week that while this isn't a replica of the 90s, it does smell a bit like it. And as for the Fed, Klarman went on to say that he felt the Fed acted heroically in 2009, but ultimately then it was a mistake that they kept hammering those accommodative policies of zero interest rates and keeping them there for a decade that followed that. Of course, I can't talk about Greenspan, though, without focusing on the famous quote, which he'll be best known for, which was irrational exuberance. And he said this in a speech, I think at the American Enterprise Institute in 1996. He was saying, and this is a paraphrasing of the quote, but he said, it was hard to know when this irrational exuberance was going to lead to unduly inflated asset prices, which would then lead to unexpected and prolonged contractions, which was pretty timely because this would happen a few years later when the bubble, of course, did burst in 2000. And the S&P 500 from 2000 to 2010 saw a decade with an average annual return of 0%. Greenspan remained at the Fed through that collapse of the tech bubble and responded again with lower interest rates and a flood of liquidity, which reinforced further this idea of a Fed backstop and ultimately continuing support, which is kind of latent in the wings today, of government support for the free markets. And that support and the free-willing lending and development of financial instruments to capitalize off that lending ultimately led to a steep recovery. And then the housing bubble, which came next, as we saw complete moral hazard left the bankers and instead was shouldered by the investors and ultimately the federal government. And that led to this terrible collapse in 2008. And lastly, luckily, perhaps it was luck, perhaps it was with somebody's foresight, but as Greenspan retired from the Fed, he was replaced by a Fed chair whose specialty, whose doctoral thesis was a study of monetary policy during the Depression. And Ben Bernanke came in and took that Greenspan put to ever new levels. He incorporated what was became known as the Fed toolkit. In addition to the put and the backstop, now we had the Fed toolkit to not only lower interest rates to zero, inject liquidity into the banks, but also attempting to manipulate the long end of the yield curve to keep the financial system from going permanently off the cliffs and into the abyss. Now, all of these policies kept the ball rolling, but also, of course, incurred tremendous national costs which are still being faced or maybe ignored today. Borrowing today in the markets is explosive in scale, and it's used to fund this new wave of technological expansion, as I was talking about earlier, and enabling this period where demands are outstripping supply. So I was really supposed to be a little bit tongue-in-cheek when I used the term free markets. Hopefully, we're going to avoid another ride like we saw then. As I said, I am not saying that this is a bubble. That is not our base case. But as we lost Alan Greenspan this week, it's a good time to reflect on the challenges that he faced, how he faced them, and as an investor, consider what risks we're exposing ourselves to today. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.